In the good old days, managers were paid a base salary, played golf most afternoons, and stayed with a company for several decades. Since the American economist Morgan Friedman came up with the idea of shareholder value in the 1970s, incentives for managers have become ever more complicated, and investors need to be more alive to the fact that these can also have massive unintended consequences. In our due diligence series, we are looking at how not really paying attention to how managers are being incentivized has cost shareholders vast amounts of money. Persimmon is one of the UK's biggest house builders with a reputation for generating big returns for shareholders. However, in 2018, a badly designed incentive management scheme shredded the company's professional reputation and cost its management their jobs. Our article on the Interactive Investor website looks at the lessons that shareholders can learn from this debacle. Investors must also be alive to the fact that they might not have an adequate idea of risk when demanding that management follows a certain strategy. We assess what went wrong during the banking crisis in 2008 and ask whether investors also have to shoulder some of the blame for the woeful management of banks in the run-up to that crisis. There is a clear lesson about how false incentives can work both ways in the market. History might ultimately be kinder to the banks now that more than a decade has passed.